Good afternoon, and welcome to the Capital Markets Financing Program breakout session at the EXIM Bank Annual Conference for 2021. My name is David Fiore, and I'm the Vice President of the Transportation Division here at EXIM Bank. I will be the moderator for this panel. Today, we will discuss various topics related to EXIM Bank's funding of capital markets supported transactions through the capital markets. We will also discuss how other export credit agencies use the capital markets to support their exports as well. I'm very happy to have with me today three distinguished panelists for this conversation. The first is Paxton Stefan. Paxton is a senior policy analyst with the Office of Policy Analysis and International Relations here at EXIM Bank. Paxton specializes in domestic and international banking, insurance, and capital markets issues as they affect EXIM Bank's ability to meet its mission of supporting U.S. exports. Paxton is also a key player in managing the relationship with the Private Export Funding Corporation, also known as PEFCO. Our second panelist is Eric Ponzio. Eric is the Executive Director of Structured Products and Government Finance at JP Morgan. Eric is responsible for originating, structuring, and executing financings related to commercial and agency-backed financings in both the debt capital markets and bank loan market. Eric covers a variety of assets and industry classes in his work. JP Morgan has been one of the largest arrangers of EXIM Bank supported capital market issuances since the program began in 2009. And our third panelist is Mr. Joshua Gentner. Josh is a partner in the global transport practice at the distinguished law firm of Smith, Gambrell & Russell, LLP. Josh represents clients in connection with a wide variety of aircraft, debt, equity, and lease financings, and he has represented EXIM Bank in connection with many aircraft financings and structured financings as well. Josh is our lead counsel in connection with capital markets funded transactions. So again, I'm very happy to have a distinguished panel today to be able to discuss this interesting topic with us. So Paxton, let me first begin with you. I was wondering if you could set the stage for us by discussing the various types of various sources of funding that are available to support EXIM Bank's supported transactions.
Thanks, David. There are four main sources of funding for EXIM deals. One is EXIM itself via direct loan. Two are via financial institutions through a guaranteed loan. Three are directly through the capital markets via a guaranteed bond. And then four are indirectly to the capital markets via a PEFCO funded guaranteed loan. EXIM direct loans are exclusively made in US dollars at a fixed interest rate. Interest is charged according to the OECD commercial interest reference rates, or the SEER rates, and are published on EXIM's website and updated monthly. EXIM guaranteed loans or bonds, are available in multiple currencies and can be fixed or floating rate. There is no minimum rate for these loans or bonds as they are provided by private sector entities, either banks, non-bank financial institutions, PEFCO, or institutional investors at prevailing market rates.
Thank you, Paxton. Eric, as a financial advisor to clients, in light of the smorgasbord of financing options or funding options that Paxton just went through, when would you recommend a borrower use a certain funding structure over another? For example, PEFCO versus a capital markets versus a commercial loan?
It's a good question, David. I would say that different EXIM debt structures, they do all have different benefits and considerations when we compare them. And therefore, also the optimal funding methodology will depend on a case by case. So I typically recommend borrowers, they need to work closely with the bankers and EXIM Bank, of course, to analyze the particular funding need they have, the project need they have ahead of themselves, and the various requirements and particular considerations to assess the most suitable financing structure. Let me give you an example, David. In the event that the borrower has, let's say, a multi-year disbursement requirement, a combination, for instance, of, let's say, guaranteed loans and guaranteed bonds might be a good solution, as the capital markets in this particular case, the execution is much more cost efficient when we have a greater size of the debt that needs to be issued to institutional investors. So that in this scenario, you can use the bank loans as a warehouse to disperse smaller loans that you later on can aggregate to access capital markets investors.
Thank you. Josh, turning to our counsel to ask some legal questions. You've been as I mentioned, you've been our lead counsel on all the capital markets funded transactions that EXIM Bank has done. And the financing structure for a commercial bank funded transaction and a capital markets funded transaction are very similar, but there are some important differences in terms of the EXIM Bank documentation. I was wondering if you could please summarize for us some of the major differences or changes in EXIM Bank documentation that are needed when there's a capital markets funding.
Of course, thanks, David. When we developed the capital markets product, our goal was to make the transition for EXIM's customers from a bank deal to a bond deal an easy one. We had a mantra, which was simple, consistent, and seamless. So with that in mind, when we went to the standard EXIM Bank documentation, we tried to make as few changes as possible so that the documentation would remain familiar to all of EXIM's customers. That said, there are some differences between a loan deal and a bond deal. On the documentation side, instead of using a credit agreement or a loan agreement, we now use an indenture. The terms are really very similar. The indenture just focuses on issuance of notes as opposed to the granting of loans from a financial institution or EXIM under a credit agreement or a loan agreement. There are some new documentation that's entered into when we have a bond transaction. There's a note purchase agreement, which is a standard form document that's entered into between the issuer and the investment bank. And it contains standard representations and warranties and indemnities in connection with the bond issuance. And then there's an offering circular, which is our disclosure document, with its primary focus being on the EXIM Bank guarantee. There are other substantive differences between a capital markets deal and a loan deal. The first being that institutional investors will charge a make-whole amount in connection with a prepayment of a fixed rate bond, whereas banks would charge a swap breakage. The other main difference is instead of using a loan agent, we use an indenture trustee. That indenture trustee's role is to hold the bonds on behalf of a clearing agency like BTC, to process payments, and must have a master agency agreement with the clearing agency. That master agency agreement is very important because it allows the indenture trustee to not only keep these physical possession of the notes, but to transfer those notes to EXIM Bank in connection with a claim being made under the EXIM Bank guarantee. In our experience, existing EXIM customers have found the transition from a loan deal to a bond deal to be simple, consistent, and seamless.
Great, thank you, Josh. Paxton, why don't you give us, in your role in the Office of Policy Analysis, you obviously track these different financings, and I was wondering if you could give us some historical background on the EXIM Bank's capital markets program between 2009, at the time of the financial crisis, and 2015. Just sort of set the stage and give us some historical background.
Sure, David. First, I wanted to mention that this is the third iteration of the capital markets program during this period, during and following the global financial crisis. Both earlier efforts in the mid-70s for a nuclear deal in the Philippines and in the 90s for large CGFs eventually lost out to widening and more sophisticated banking practices. However, the most recent iteration of the EXIM program, like I said, started during the global financial crisis when there was a constraint on bank funding for guaranteed loans. In contrast to these earlier iterations, there aren't any indications that the current program is going to be obsolete anytime soon. We see a demand for this program going forward as a source of funding for EXIM deals. Furthermore, I wanted to mention that EXIM, while it lost its board quorum in mid-2015, capital markets issuances are linked with disbursements, not with authorizations. So while the board wasn't here to authorize new transactions at the time, there were capital markets deals that went into the market through December 2016 on transactions that were authorized before the loss of board quorum at EXIM. From October 2009 to December 2016, there were over $26 billion in EXIM guaranteed bonds that were issued into the market, including 5 years where there was over $1 billion issued in a year. Over this time, there were 165 issuances, and the average issuance was around $160 million. During this time, EXIM was able to expand the program from its start as a fixed rate funding source for aircraft deals. In 2011, the program had its first floating rate issuance and its first non-US dollar denominated issuance. And in 2012, the program had its first non-aircraft deal and also had its first pre-funded deal, which I know we're going to be talking about shortly. Overall, however, the capital markets program created another funding source for EXIM transactions at a time when one of the other funding sources, financial institution funded guaranteed loans, was constrained, which allowed EXIM to use fewer direct loans and include more of the private sector directly in EXIM transactions.
Thank you, Pastor, for that perspective. So, Josh, turning again a little bit to the regulatory aspect, are there any differences in disclosure requirements for EXIM Bank borrowers in connection with capital market financing relative to what would have to be disclosed for a non-EXIM, non-capital market financing?
Well, the lawyer answer is that depends. What it depends on is the underlying credit for the transaction. The purpose of a disclosure document is to provide enough information so that an investor can make an informed investment decision. So accordingly, in a non-EXIM capital markets transaction, the primary focus is on the credit. So you're going to look at if the issuer is the credit, you're going to find a fulsome disclosure of the issuer. If, however, that bond is wrapped by an insurance company or guaranteed by a third party, then that disclosure document would focus more on that insurance company or the third party guarantor. So in an EXIM transaction, EXIM Bank is guaranteeing the notes of the issuer. So accordingly, the disclosure is going to be focused on the EXIM Bank guarantee, which has the full faith and credit of the United States government. And while the securities that are issued are exempt from registration under Section 382 of the Securities Act, they're not exempt from the misstatement and omissions liability, which is why we have an offering circular. And as I discussed previously, our offering circular focuses primarily on the EXIM Bank guarantee. And as EXIM Bank guarantees across all these transactions are very similar, then the offering circulars are also very similar, with only changes really to reflect the differing structures of the transactions or the different assets being financed. One question we get a lot from new issuers is how much disclosure is going to be required on the issuer. And what we find, because of the focus on the EXIM Bank guarantee, is that it's usually only 1 or 2 paragraphs concerning the issuer. That said, we do find some issuers who take this as an opportunity to get more information about their company into the market. And so they'll provide a more fulsome description of their business. But in no event are any financials of the issuers ever included in an offering circular. So to answer your question, with respect to the issuer, in an EXIM Bank transaction, the disclosure requirements are very limited.
Now let's talk a little bit about mechanics, how actually funding can take place. Eric, having done lots of capital markets issuances, could you please walk us through the difference between a reimbursement, a refinancing, and a pre-funding of a capital markets funding, an EXIM Bank supported capital markets funding, and describe some of the advantages and disadvantages of each approach?
Certainly, David. And given that we are in this panel, we're focused on discussing capital markets, I will use that as the baseline of comparison, for comparison for the 3 various methodologies for funding itself. So let's start with a reimbursement. So in a reimbursement type of funding structure, what we would do is that the borrower would be in a position to make cash payments when various payments are due, in reference, let's say, to an installment schedule or to deliveries of aircraft taking place and so forth, after which EXIM Bank guaranteed bonds can be issued to reimburse the borrower for that type of advances. Now, the pros with that is that the borrower wouldn't have any associated loan costs to the funding itself. And it wouldn't either have any negative carry, which is something that arises from a pre-funding structure. However, if we are looking at some of the considerations, those would be that, one, the cost of cash versus the cost of debt, and also the availability of sitting with, from time to time, large sums of cash at hand. Now, if we move forward to the second alternative, the refinancing, which has been the most commonly used one, how that works is that there would be an EXIM guaranteed bank loan facility that in the interim provides various loans disbursements as payments are due, after which the guaranteed bonds are issued to refinance those drawn loans with the proceeds from that offering. A benefit with this type of methodology is that the borrower will have complete certainty of pricing from the bank that provides the loan facility. As we in the capital markets, we typically, for these type of transactions, place and price on a best effort basis. And there would not be any negative carry either associated with pre-funding, as mentioned previously. Now, some of the considerations are that those additional loan costs would be occurred, and some additional documentation as well, if you have, depending on the type of asset that you're financing. If you're looking at an aircraft deal, you would have an initial loan closing as well, and the documentation associated with that. Now, to move forward to the last methodology, the pre-funding that Paxton also mentioned, that we worked on structuring and launching in 2012. How that works is, and this is a commonly used technology in the aviation industry in particular, is that we would be issuing a bond ahead of the exports actually occurring, so the funding being needed. And these guaranteed bonds, the proceeds from that offering, would be escrowed. And from that escrow account, they would be dispersed as payments will take place, or the export itself will take place. The benefit of this is that you will get the certainty of both pricing and funding in the capital markets at the time that you issue that bond. And again, you wouldn't have any other associated cost to loans or the cost of cash that needs to be deployed. However, depending on that was being held in the escrow account, so you would incur negative carry. Now, having mentioned these three alternatives, David, one big benefit with the EXIM Bank program for capital markets is that they can be combined. So you can ultimately structure a transaction whereby you can utilize all three methodologies and tailor the final funding structure as you're going through your disbursement needs.
Thank you, Eric. But I think a key aspect of the pre-funding is the exporter has to be very certain that the exports are actually going to take place within a pretty finite period of time. Otherwise, there could be complications.
Absolutely.
Yeah, David, to add on to that, we do set a window where the investors have a set period where they know that they're going to either have used the proceeds to finance the equipment, or they'll be getting prepaid. So there is a finite window, and that's, as you said, yes, we need to know that the manufacturer will be able to deliver within that window.
Yeah, that's a good point. Thank you, Josh. So Eric, why don't you, Paxton mentioned that the last capital markets funding was a few years ago. And so I was wondering if you could give us sort of a picture of the current state of the capital markets and what what investors' appetites are for risk right now, especially in light of the COVID pandemic and other things going on in the world right now.
Certainly, David. Over the last year, we've seen quite a strong demand for high quality assets amongst capital markets investors, in particular for US government-related securities. And this is something we've seen that in times of uncertainty, there's been a lot of flight to quality. And we experience a significant demand around these transactions as we have announced them and placed them in the market. For example, when EXIM Bank returned to the capital markets earlier this year in February, following the hiatus that Paxton mentioned since December 2016, I think it was, Paxton. we were able to execute an EXIM guaranteed bond at a historically low spread for that particular tenor, on the back of a very strong support amongst the EXIM Capital Markets Program investor base. So that was a milestone transaction, I would say, for the EXIM Bank program, demonstrating as well that despite the hiatus, the demand remains strong, and as we saw then, particularly strong for this particular asset class.
And actually, I'm glad you mentioned the issuance earlier this year. Did you notice any difference in the spread of investors, or the type of investors, or any changes in the type of investors that were interested in that issuance that was done in February and March? The issuances are actually two of them that were done in February and March of 2021.
Well, having placed a significant amount of these type of bonds, we know that there are certain investors that are commonly recurring investors and are dedicated to the program as well. And then there's also some new investors from time to time that get involved in the program and have more demand amongst these type of assets. The relaunch was received extremely well amongst these investors. And what evidenced that was a very robust and oversubscribed order book, as we announced the transaction and marketed during the announcement day. Now, because we saw a lot of demand, that also resulted in this high spread compression, which allowed us to price at a very tight spread over the benchmark rate. So given that, as well as many of us know, that interest rates are at a historical low, and the tight spread coupled with the very low interest rate environment resulted in a record coupon for the particular issuer in this case.
Great. As we all know, Eric, staying with you for a minute, EXIM Bank is not the only U.S. government agency that uses the capital markets to achieve its mission. There are other U.S. government agencies such as USAID, the Development Finance Corporation, and the Small Business Administration that have also issued bonds in the capital markets. And I know JP Morgan has been involved in some of those issuance as well. I was wondering if you could talk a little bit about how those other agencies use the capital markets, and how the way they use them differs, or is similar to, or differs from the way EXIM Bank capital markets issuances work.
Absolutely, David. So in a similar construct as the EXIM Bank Capital Markets Program, whereby the guarantees attached to the actual note itself, so the bond itself, let's focus on those as those are most relevant. The format itself is similar. So, and that goes back to the formal format that Josh mentioned, these exempt transactions that are exempt under Section 3A2 in the 1933 Securities Act. Now, they do differ in terms of underlying structure. If we focus on tenors, repayment profiles, some of these are bullets, some of these are amortizing type of structures, the size and the regularity to market. Those make some differences amongst these type of assets, which also creates a slight pricing differential.
And I think it's also important to note that even though the EXIM Bank guaranteed capital markets issuance is being funded in the capital markets, it still has to comply with the OECD arrangement and the terms and conditions that EXIM Bank is obligated to follow. So things like bullet bonds, or no interest only, and then a bullet payment at the end, that just, it does not work with the OECD arrangement. So I think that could be also part of the differences in some of the.
Absolutely, David.
Yeah. And just as we're not, EXIM Bank is not the only U.S. government agency to use the capital markets, we're also not the only export credit agency to use the capital markets. I mean, Paxton, I know you track the activity, capital markets activity of other ECAs, and Eric, I know you've been involved with some of our competitor ECAs, such as the Korean EXIM Bank and the UKEF, the British Export Credit Agency. I was wondering if the both of you could talk a little bit about how other export credit agencies, how active they are, what they do, what's their experience been in the capital markets financings to support their exporters. I don't know if whoever wants to go first, I'll just throw it out there.
Let's Paxton go.
Sure. We've seen a few different other export credit agencies use this tool as a way to provide financing for their borrowers as well. The ones that come to mind off the top of my head are BPI France, UKEF, Korea EXIM Bank, and Serve. So those are the main ECAs that have used the capital markets as a tool for their financing packages. Now, I will say that at least for BPI and UKEF, they're mostly focused on aviation deals, which, like I said, our program started that way, and now it's kind of expanded outside of that realm as well. And in particular, the recent deal from Serve was interesting because it was for project finance, which is something that we haven't quite been able to get to work for our guarantee yet, but it's something that we want to try and look at in the future as a financing option for our customers to support U.S. exports.
Actually, Paxton, you raised a very interesting point about project finance. Most of the capital markets financings have been for discrete assets like helicopters and aircraft and maybe some large corporate borrowers. What are some of the challenges with using a capital markets funding in connection with the project finance?
Sure. So one of the biggest obstacles that comes to mind is just a long disbursement period where there's a lot of uncertainty about when the project will be complete. And if there are schedules that slip, there isn't necessarily that flexibility in capital markets products, or if there is, then you have to pay a lot to have that flexibility. So it's less economical for the project as a whole. So that's one of the main reasons from my perspective as to why we haven't quite gotten that to work yet. But like I said, we're looking into it, and we would like to hopefully find a solution that will be able to work for our clients in the near future.
Very good, very interesting. Well, that concludes our discussion for today. I'd like to thank you all for listening, and I would like to thank very much our three panelists for their time and for sharing their expertise with us today. I would like to now open up the discussion to questions from the audience. Thank you again very much.